Day trading or investing? Same market, opposite physics. Which one actually fits you? Here's the answer.
Two people put $10,000 into the same stock on the same day. One sells it that afternoon. The other holds for 10 years. Same instrument, same market, same starting capital. The expected outcome? Worlds apart. One returns roughly 7% real annually. The other carries a 70 to 95% chance of losing money. Day trading and investing share one thing, an instrument. That's it. Day trading means opening and closing positions inside a single session, minutes to hours. The edge comes from short-term price moves, microstructure, and news reactions. Investing means buying and holding for months to decades. The edge comes from earnings growth, dividends, and compounding. The instrument is identical. The physics are inverted. Take Apple. $1 allocated to AAPL in 2014 and left alone returns several 100% by 2024. Pure holding. The same dollar churned daily in AAPL over the same window? A fraction of that, after commissions and taxes. And that's before we account for the dispersion between traders. It's not the asset doing the work, it's the holding period. That framing changes once you look at what each one actually costs you to enter. Day trading in the US has a hard floor. FINRA Rule 4210, the pattern day trader rule, requires $25,000 minimum in margin. Practically, you want $25,000 to $50,000 to absorb the losing streaks that always come. Investing? $5 to $10 buys a fractional share of any index fund. Anyone can start. Time is even more brutal. Day trading is 20 to 40 hours a week of continuous market hours focus. It is a second full-time job. Investing is 1 to 4 hours a month, a quarterly review at most. That alone disqualifies day trading for most working professionals. You cannot do this between Zoom calls. The market does not care that you have a day job. So is day trading actually profitable for the people who clear that bar? This is where most content lies to you. Here is the actual data. A 2020 Brazilian study of retail day traders. 97% of traders with more than 300 trading days lost money. Only 1.1% earn more than the Brazilian minimum wage. A Taiwan cohort study by Barber-Lee-Liu-Odean. Less than 1% of day traders reliably earn positive abnormal returns net of fees. ESMA-style retail disclosure from regulated brokers. 70 to 85% of retail CFD accounts lose money every single quarter. Now flip the camera. Passive investing across a century of US data. Roughly 5 to 7% real annualized returns. Periodic 30 to 50% drawdowns, yes, but a stable, mostly positive long-run distribution. The reason you don't hear about the 90% who lost money trading? Survivorship bias. The traders posting on YouTube and X are the survivors. The losers don't post. And the gap between the two distributions doesn't just exist in returns. It's manufactured by three cost lines that asymmetrically favor the investor. First, trading costs. A zero commission trade is not free. Bid-ask spread, payment for order flow execution, exchange fees, roughly 0.05 to 0.15% per round turn on retail US equities. 5 round turns a day, 250 trading days, 625 to nearly 1900% in cost turnover annually. Money buy and hold investors literally never pay. Second, tax friction. In the US, long-term capital gains held over a year are taxed at 0, 15, or 20%. Short-term gains, taxed as ordinary income, up to 37% federal. Add wash sale rules deferring losses across 30-day windows, and the typical drag is 5 to 15 percentage points annualized versus a sheltered portfolio. In the UK, the picture rhymes. ISO-sheltered investing pays no tax on dividends or gains. Frequent trading outside an ISA generates capital gains tax and potentially trading income classification. Third, behavioral drag. Investors lose 1 to 2% annually to mistakes, selling lows, buying highs. For day traders, the feedback loop is faster, so the damage is worse. Every losing trade is a dopamine hit. Every winning trade inflates overconfidence. Without exceptional discipline, the behavioral cost of day trading exceeds the strategy's gross edge.
None of that means day trading is always a mistake. It has a real role, but only under specific conditions. You need long-term investing already in place, tax-sheltered index portfolio funded, retirement contributions current. You need a dedicated trading account funded only with money you can afford to lose entirely. You need to treat it as a 1 to 3 year skill acquisition project with no profitability expectation in year 1. You need 20 plus hours weekly and the temperament to absorb daily P&L swings without it leaking into the rest of your life. And you need a trade journal reviewed
weekly with statistical rigor, not intuition, statistics. Meet those 5 conditions and a small day trading allocation becomes a legitimate pursuit. A small subset of disciplined operators do reach consistency, but the structure has to start from investing as the default, trading as the optional skill, never the other way around. Here's how experienced operators actually structure it. 80 to 90% in low-cost index funds, tax-sheltered wherever possible, Roth IRA, ISA, pension wrappers, monthly contributions, quarterly review at most, 5 to 10% in single-stock concentrated investing, researched conviction bets held 12 to 36 months, earnings-driven theses, not chart-driven ones, 5 to 10% in an active trading sleeve, strict 1% risk per trade, hard daily and monthly stop-loss limits, funded with money you are explicitly willing to lose, plus a 3 to 6 month cash buffer outside both accounts. That cash is not investable risk capital. It is the foundation that lets you not panic. Then once a year, rebalance back to target weights. Move profitable trading sleeve gains into the core. Refund losses only if the core is overweighted. Now the verdict. Remember the 70 to 95% loss rate from the academic studies? That is not bad luck. That is the predictable output of a strategy where the cost structure, the tax treatment, and the behavioral feedback loop all compound against you, while passive investing has all 3 working for you. So here's the action. If you're starting from zero, build the index core first. Automate the contributions. Then, if you still want to trade, open a separate small account, treat it as a 3-year skill project, and protect the long-term picture from the worst-case outcomes. Investing is the default, trading is the option. Get that order right, and you get to keep both.
Investing is the default. Trading is the option. Full breakdown linked in the description.